Hello, my dear students. I hope you have been doing well. Today we are discussing solution of one of the assignment problems. I gave you two assignment problems, problem 4a5 and problem 4a6. Today we are discussing solution of the problem 4a5. What you are supposed to do from that problem: first we will pass adjusting entries, then we will prepare adjusted trial balance, then financial statement, income statement, statement of owner's equity, and balance sheet. So this is the problem 4a5. Village Theatre closes its accounts each month at July 31st. The trial balance and the other information given below were available for adjusting and closing the accounts. So now this is the trial balance of Village Theatre before adjustments for the month of July. Now after this trial balance, if you can see that other data, these are the 7 adjusting entries are given. Now what you are supposed to do: first we will pass adjusting entries, then we will merge these adjusting entries with this trial balance which is already given in the problem, and we will prepare new trial balance that will be called adjusted trial balance, and then from that adjusted trial balance we will prepare financial statements. So first, now we are passing adjusting entry. So I will read transaction, and then we will record that transaction into adjusting entries journal. The first transaction is that film rental expense for July amount to 21,050. However, the film rental expense for several months had been paid in advance. Now if you can see in the trial balance, company has prepaid film rental of 31,200. So if you pay some amount in advance for any expense, that is considered as a current asset. So we will record on debit side. So that's why it is given in trial balance as a asset, prepaid film rental. Now out of that 31,200 prepaid film rental, the expense which is incurred for the month of July amount to 21,050. Now village theatre's expense of film rental for the month of July is 21,050. So we will record that on debit side, film rental expense 21,050. As prepaid film rental asset is decreased by 21,050, so decrease in assets is recorded by credit. So we will credit prepaid film rental 21,050. The explanation will be to record the part of prepaid film rental expired in the current month. This is all about transaction adjusting entry A. Adjusting entry B. The building is being depreciated over a period of 20 years. The value of building is 168,000 and its estimated useful life is 20 years. Now you have to calculate depreciation on building for the month of July. How can you do that? The value of building 168,000 divided by 240 month, then you can get the depreciation for month of July. Or other way, you can also calculate as the value of the building, cost of the building 168,000 divided by 20, then the resulting value is again divided by 12. In this way you can also get depreciation expense for the month of July, that will be 700. Now we will record that entry: date July 31st, depreciation expense building debit 700, accumulated depreciation building credit 700. As we have already discussed, accumulated depreciation is contra asset account which is shown on credit side. So explanation will be to record the depreciation on building for current month. So that's all about adjusting entry B. So adjusting entry C, the projection equipment is being depreciated over 5 years 60 months. So this is again same process, is same, either it is building or machinery or office equipment. Now same way we will also charge depreciation on projection equipment. The cost of the projection equipment is 36,000 and the estimated useful life is 5 year or 60 months. So 36,000 divided by 60, the depreciation expense for the month of July will be 600. So we will debit depreciation expense projection equipment 600, credit accumulated depreciation projection equipment 600. This is all about transaction C. Now transaction D. At July 31st, accrued interest payable on the notes payable amount to 1650. No entry has yet been made to record interest expense for the month of July. So interest expense is incurred on notes payable 1650, which is yet not recorded, so we will record that. And it is also not paid by the village theatre. They will pay that later. So new liability is created which will be called interest payable. So expense incurred is 1650, which we will record on debit side. Interest expense 1650 debit, and credit interest payable as liability is increased on credit side 1650. Explanation will be to record the interest expense incurred on notes payable for the month of July. So that's all about transaction D. Transaction E. Village Theatre allows the local YMCA to bring children attending summer camp to the movies on any weekday afternoon for a fixed fee of 500 per month. On May 28, the YMCA made a 1500 advance payment covering the month of June, July, and August. Now, YMCA is customer of Village Theatre. That customer YMCA makes advance payment of 1500 on 28th month. So 1500 are for 3 months, 500 for the month of June, 500 for the month of July, and 500 for the month of August. Now we are passing adjusting entries for the month of July. Now if you can see that in the trial balance, unearned admission revenue YMC on credit side is 1000. Why it is called unearned means amount which is collected in advance but service is not provided to the customers is called unearned revenue. So revenue of village theatre is called admission revenue. So that's why here in trial balance it is written unearned admission revenue YMCA 1000. Why it is 1000 not 1500 as YMCA paid 1500? Because YMCA paid 1500 on 28th May. 500 were for the month of June. So Village Theatre earned 500 revenue for the month of June. So unearned revenue was decreased by 500 after June. So from 1500 it is now unearned admission revenue decreased to 1000 for the month of 1000 in July. Now 500 are for the month of July. So again we will decrease unearned admission revenue 500 in the month of July as company Village Theatre has earned revenue for the month of July is 500. So we will pass adjusting entry to decrease unearned revenue. So liability is decreased because Village Theatre has revenue is earned and unearned revenue liability is decreased. So decrease in liability is recorded by debit. So we will debit unearned admission revenue 500, and for revenue earned we will credit admission revenue earned 500 on credit side. So that's all about transaction E. Transaction F. Village Theatre receives a percentage of the revenue earned by the Testia Corporation, the concessionaire operating the Snake Bar. For Snake Bar sales in July, Testia owes Village Theatre 2250 payable on August 10. No entry has yet been made to record the revenue. Credit concession revenue. Now within the Village Theatre there is a Snake Bar called Testia Corporation. Now Village Theatre earns revenue from that Snake Bar every month. Now for the month of the July, Village Theatre has earned revenue of 2250. But Snake Bar has not paid amount to Village Theatre. So Village Theatre will collect that amount in the month of August. So still they have not received the amount. So they will show amount receivable from that Testia Corporation customer. But they have revenue earned. So they will show that revenue in their adjusting entries for the month of July. So they will debit concessions revenue receivable 2250 and credit concession revenue 2250. Explanation will be to record the concessions revenue receivable and related revenue earned from a concessionaire called Testia Corporation. So that's all about transaction F. Transaction G. Salaries earned by employees but not recorded or paid as of July 31st amount to 1,500. No entry has yet been made to record this liability and expenses. Now, expense of village theatre incurred for the month of July is 1,500, but village theatre has still not paid these salaries to their employees, so they will pay later on. So that's why they have to show that salary payable. So liability is increased and expense of salary expense is also incurred, either they have made payment or not. So they will show that expense into books of accounts. So on July 31st, they will pass adjusting entry: salaries expense debit 1,500, salaries payable credit 1,500. The explanation will be to record the salaries expense and related liability to employees for the month of July. So that's all about transaction G. So these are the all adjusting entries that we have discussed. Now we will merge these all adjusting entries with the already given trial balance of village theatre and problem in question, and we will prepare new trial balance that will be called adjusted trial balance. Now this is the adjusted trial balance of village theatre for the month ended July 31st, 2019. Now the trial balance which is already given in problem, the accounts which were not affected due to adjusting entries will be kept same as it is, just like cash, and some accounts which are affected due to the adjusting entries, now we will merge adjustments with these accounts, and now we will record these accounts again into adjusted trial balance. Some new accounts were also created in adjusting entries, so these new accounts will be created where they best fit. As we have already discussed, suppose new account created is a current asset, then it will be entered into sequence of current assets in adjusted trial balance. If new account created is an expense, then that will be recorded along with all other expenses which are already given in trial balance. This is how we prepare adjusted trial balance. Now if you can see that the cash which was already given in trial balance was 20,000. Now we have kept same cash of 20,000 because cash is never involved in adjusting entries. Now the second title of accounts that we have given in adjusted trial balance: concessions revenue receivables, because in sequence of adjusted trial balance or even in trial balance or even in balance sheet, first we record current assets, now in sequence after cash we show receivables. So that's why we have shown here new account which was created in adjusting entries, that was concessions revenue receivable 2250 on debit side. Now prepaid film rental before adjustments there was 31,200. Now out of that 31,200, 21,050 was expired for the month of July. Now remaining balance and prepaid film rental will be 10,150. Land we have kept as it is 80,000. Building, the cost of the building is also kept same as it is 168,000. Now accumulated depreciation before adjustments which was given in trial balance was 10,500. Now depreciation expense on building charged for the month of July was 700. Now new balance and accumulated depreciation on building is as 11,200 recorded on credit side, as contra asset account is always recorded on credit side. Then projection equipment value same we have taken from the already given trial balance 36,000. Now accumulated depreciation before adjustments there was 3,000, now 600 for the month of July. Now balance and accumulated depreciation projection equipment on credit side will be 3,600. So that's all about assets in adjusted trial balance. Now liabilities notes payable is also taken as it is 190,000. Accounts payable liability is also taken as it is 4,000 400. Now we have created a new account, interest payable in adjusting entry, so it's also recorded here, interest payable 1650. And another new account was also created, salaries payable, which we have also entered here, salaries payable 1500. And then unearned admission revenue before adjustments was 1000, as out of that 1500 revenue was earned for the month of July. Now balance, because unearned admission revenue was decreased by 500, now on credit side there will be remaining balance of unearned admission revenue YMCA will be 500. So that's all about liabilities. Now Lightrong capital we have kept same as it is, 103,400, and drawings we have also kept same as it is, 3,500. Now revenues accounts, admission revenue now as 37,400. Before adjustments it was 36,900, but after adjustments revenue earned now at the end of the month, admission revenue is 37,400. And company also earned an other revenue of concessions revenue from Snake Bar 20 2250. So 2250 is also recorded along with that admission revenue on credit side of adjusted trial balance. Now expenses, salaries expenses already which were given in trial balance. Now salaries expense incurred for the month of July, 1000 1500 are also added to the already existing 8700. Now new total salaries expense for the month of July will be 10,200. Light and power expense we have kept as it is because there was no adjusting entries related to this 1800. Now new other expenses which were created in adjustments are kept here, just like film rental expense 21,050, depreciation expense building 700, depreciation expense projection equipment 600, interest expense 1650. Now all accounts of debit credit have been recorded into adjusted trial balance. Now our adjusted trial balance total of debit side will be 355,900 and on credit side it will be 355,900. So that's how we prepare adjusted trial balance. Now all accounts are given, our adjusted trial balance is ready, from which now we can prepare financial statements. In financial statements, first we prepare income statement. Now, for preparation of income statement, we have taken revenues from adjusted trial balance and then expenses from the adjusted trial balance. Revenues given on credit side of adjusted trial balance: admission revenue 37,400, concession revenue 2,250. Total revenues for the month of July 39,650. Now we have here given all the expenses in the sequence as these were given in adjusted trial balance. Salaries expense 10,200, light and power expense 1,800, film rental expense 21,050, depreciation expense building 700, depreciation expense projection equipment 600, interest expense 1600. Total of all these expenses will be 36,000. Now net income is difference between revenues and expenses. Excess of revenues or expenses is called net income. If you can see that now revenues are greater than expenses. So total revenues 39,650 minus total expenses 36,000. So net income for the month of July is 3,650. So that's how we prepare income statement. Now we will prepare next financial statement. Village Theatre statement of owners equity for the month ended July 31st, 2019. So now first we show the trial balance, Lightrong capital which is given in the trial balance before adjustments 103,400, and now in first financial statement. Before that statement of owner's equity, we prepared income statement. We derived income of for the month of July 3650. Now we will add that income for the month of July to the existing balance of the owner's equity or Lightroom capital. Now income of 3650 is added. Now we will total both and subtotal will be 107,050. Now we will subtract drawings by the owner. Now if you can see that on adjusted trial balance on debit side there were drawings by the owner 3500. Now these are deducted from the subtotal. Now light round capital by the end of the month of July on last date will be 103,550. So this is the capital we will show in the next financial statement balance sheet. So now this is the balance sheet of Village Theatre on July 31st, 2090. In balance sheet we show assets on the debit side and liabilities and owner's equity on the credit side. So now we have taken as it is assets from the adjusted trial balance cash 20,000, concessions revenue receivable 2,250, prepaid film rental 10,150, land 80,000. Now original cost of the building was 168,000. Accumulated depreciation by the end of the month of July till July on building was 11,200. Now after deducting that 11,200, the book value of building is 156,800. This is the value at which we show assets in balance sheet. Similarly, we have shown the book value of projection equipment, original cost of the equipment 36,000 less accumulated depreciation 3,600. Now the book value of accumulated book value of projection equipment is 32,400. So now the total of all these assets is 301,600. Now on credit side, we have given here first liabilities and then capital. Notes payable 190,000, accounts payable 4,400, interest payable 1,650, salaries payable 1,500, unearned admission revenue YMCA 500. Now after liabilities we have given here Lightroom capital 103,550. The total of all these liabilities and capital is 301,600. Now you can see that total of assets is equal to the total of liabilities and owner's equity. So that's how we prepare balance sheet. So that's all about solution of problem 4a 5. That's all. Thank you.